There are two ways you can make money from stocks. The value of the stocks you own increases, therefore you have more money, and you can get paid dividends for owning these stocks, which is the profits paid out to you by the company in cash. But before you buy stocks, there are some things you need to think about. There is a risk when investing in stocks, and you need to think about the level of risk you are willing to take. If you are quite risk aversive, then you'll want to be investing in less risky assets. If you are a risk seeking person, then you will be happier with a wider variety of assets. This video is mainly aimed at the stock market, but you can include other types of assets such as property and cryptocurrencies. Different companies have a different level of risk. For example, if you pick a company like Pepsi, they have been around for over 100 years and are one of the most well-known companies in the world. They have strong brand value and even stronger economics. So this is a less risky asset. A company like Technology Minerals, they became public in 2021. They are new to the space of electric car batteries and aren't as well known as other companies in that space, like Tesla. They don't have many years of financial data free to the public, and the brand value is just not there. So I would say this is a riskier company to invest in. For a beginner, I would pick something less risky than individual stocks. There is a thing called an ETF. This is an exchange-traded fund. It is a collection of companies all bundled together in one basket, and you are buying the basket, meaning that you are buying a little piece of each company in the basket. A popular example of this is the ETF VWRL. This is the Vanguard All World ETF. So this particular ETF is a collection of stocks from companies all around the world. So when the global economy increases in value, the value of the ETF increases. Therefore, you make money. Also, this ETF pays dividends. So along with your holding increasing in value, you also get paid cash quarterly for every stock you own. You also need to consider the time horizon for your investing. Trying to time the market works out worse than time in the market. If you plan on investing for 10, 20, or 30 years, then it is easy to ignore the downturns in the market. The S&P 500, which is the US stock market, has returned on average 9.8% per year, but you never get 9.8% in a single year. Some years you'll see 20% gains, and other years you'll see 5 or 10% losses. But the longer your time horizon, the longer the fluctuations will level out, and you should see gains. Finding a brokerage or investing platform is simpler than it sounds. There are a few types of platform that you can choose from. You can pay a monthly or yearly fee for free transactions using a company like freetrade, or you can pay no monthly fee, but you'll be charged a management fee based on your portfolio size or how many trades you make, like Hargreaves Lansdown or Vanguard. Your account value and how many trades you expect to make every month will matter, so you should do some calculations on the expected fees, which you can easily find on the brokerage websites before making a commitment. You will also want to invest in an account which is tax-free. For the US, this is a Roth IRA, and for UK, it will be an investment ISA. There are also other options, but these are the two standout and easy to set up. So, as I'm from the UK, I can speak from experience. This really only takes about 5 minutes to open an account, as long as you have all the information. Then, it usually takes about a day or two for the background processes to set up your account, and then you can start investing. Also, you can play around with different investing platforms to see which you prefer. Remember that your capital will be at risk, but as long as you are sensible when you start, you don't really have to commit to any one platform. When all this has been set up, and you know the risk you wish to take, you can start investing. I found that I set up a few different accounts with different companies and didn't put any money in for a few months, as I was scared I was going to lose it all. But assuming you are going to continue to invest every month, you can just buy now. Regardless of price, just dip your toe in, decide how much you wish to invest every month, and invest about a quarter of that just to get the ball rolling. This should be a value that is not pivotal to your survival, an amount that if the company you picked goes to zero, you can lose. Once you have bought this, you will hopefully feel happier to continue adding to your positions, and this will encourage you to do more research. On the topic of research, you need to think about analysis, and more specifically the analysis of the stocks that you're going to buy. It's hard to buy anything if you overanalyze to start with, but you need to do the analysis of the things you're buying, go through the financial data, do some price analysis, go over the qualitative data, the things that value the company other than the financials. But if you're putting your money into an ETF, then it's pretty much just drop the money in every month, and you can set up an auto invest system so you don't have to think about it. You will see prices fluctuate. They will go down and you will feel bad. Did I buy a bad company? I've lost money. Should I sell now? When this happens, you should go back to the analysis. Maybe reanalyze the stock for a more recent outlook. If you are happy with that, then you should stick with it. The price going down should be a good buying opportunity for you now. This is a time to accumulate funds in a position, and then when the stock bounces back, you will reap the benefits. You will also see stock prices go up, and this is a good feeling. Seeing all that green in your portfolio, it can mess with your head. I'm a good investor. I'm the next Warren Buffett. And you may want to keep investing into those companies. But you should consider that this will erode your gains. As you are buying into the stock at higher and higher prices, your gains will go down, and your average price per share increases. Sometimes it is better to find better buying opportunities in the market with another company than to continue buying the companies that are doing well. Remember that you will make mistakes. You will miss something in the company analysis, or you will overlook some of the bad things just because you like the company. For example, I'm down nearly 20% on Disney right now. I really like the company, and I pretty much overlook the financials just because I believe in their brand value. Although I'm still holding the company for the long term, it's hard to look at the loss in this position. And finally, your goal should be to keep putting money in, not to take it out. This is not a savings account. And if you're holding for the long term, you'll want to keep the ball rolling for as long as possible to make the most gains. That is the end of the video. Thank you for watching this far into the video. If you liked the video, give it a thumbs up. Any suggestions on improvements to the video content or ideas for content going forward, please leave a comment below and I'll give you a reply.